TGIF Warriors, thank God I found F.A.C.E. TGIF. How's everyone doing today?
TGIF, Dale.
TGIF, gentlemen. So, let's see. I guess the comment's going to be, we could start off with the end since that was the feature. So, Kuroda continues to have a corrosive effect on the yen. How's that?
My Kuroda.
Yeah, I was thinking about that song. They did that with coronavirus when it first came out.
I've been using it for Kuroda since he's in office.
Yeah, but I like it. So what did he do? Say that they were going to,
nothing.
Cut rates?
Nothing.
He was looking at cherry blossoms.
He woke up, then went back to bed, a bit like me.
Yeah. Well, I saw your good morning. I know what you're having a breakfast beer on Friday morning, Ryan. I know you. Huh? You ever have a breakfast beer? Don't deny it.
Oh yeah, love a breakfast beer. 6 o'clock in the morning. Some airport.
Yeah, guys, what a week, huh?
Oh, amazing, brilliant. As I was saying on the flow show, it's one of those weeks where you get really up for it going into it the week before. You're looking forward to it. You get to about Thursday, Friday, and you think you wish they all shut up and go away.
Yeah, it feels like a month. We traded this month, and I don't know what you guys think, but partial profits in this environment is critical to your performance because you're not getting 2 days in a row of moves.
Yeah.
Euro looked ugly, then it looked good. Now what are we gonna do? We're gonna wash out, or do you buy this break in euro? Was this just another shorting opportunity before we finally take out 103.5? It's like the third time we've been here. I'm not a big believer in triple bottoms.
I don't want to repeat too much of what I said earlier to people who were on the flow show, but I said these things are a lot like roulette. Everyone puts their chips down before we get these events. Then the wheel spins, we get the number or numbers, and then all the chips move around the board again. I think we're in that moment, and you look at the ranges. That's what I do. I plot the ranges.
Yeah.
Euro dollar's gone all the way around the houses, and it's pretty much back where it started at the beginning of the week.
Yeah. A lot of markets have done that.
Yeah.
I think one thing that we could probably say we have a tell on, and I don't know if even this is going to last, but the revert, even though the yen is sharply higher, you're not getting much of a pop in 10-year.
Yeah.
And I guess this 3.25 level should be important since it was the previous high right here. So
yeah. But then look at oil. Is dollar yen on the oil bus now?
Yeah. So oil, I don't know. I just can't buy it. It still looks like it might be setting up something. S&P held this line that I had drawn off these two lows that poked through it intraday, and we're having an inside day. We're going to have a guest that's going to finally, I hope, be able to explain why, we've had this bear move in risk. And
who you got now?
Huh?
Who you got?
Oh, Jim Carroll, VIXologist. So, when you look at the bear move we've had in equities, 23% off, that we haven't, you would have thought the VIX would be at 50 on a bear move like this. So Jim Carroll, that's what he does. And I'm sure people have been asking him that question for months now. Maybe we'll get an explanation on that. So really, if you bought VIX calls, you made, some money, but you kept waiting for an explosion in volatility that never came after a pretty serious, sharp decline. So I have no idea why VIX didn't perform. So maybe we'll get some answers on that. But it does look like we got a turn in the bond market too. That was a pretty impressive day yesterday. Way overdue. So when you think about it, what the best trade was? Trading the DSI the day of the Fed. And I think the only one that wouldn't have worked was the S&Ps. But you had, single digits in euro. If you bought euro when it was single digits, you made money. If you bought bonds, you made money. If you sold the dollar, you made money. I don't think they're down there anymore, but I haven't seen, since I've been watching the DSI, so much pessimism in so many different asset classes. So that was it. Now, I don't know. Do you think we've gotten enough of the shorts out, enough of the bears in those instruments, with just one day out, one day up, and some of this stuff? What do you think?
It's going to be the key going forward, isn't it?
Yeah.
US markets are off on Monday. I think it's a half day, isn't it, for markets on Monday?
I'm not sure. It's a new holiday.
Yeah,
I think.
Well, either way, Juneteenth.
Yeah. We're open, right? Like.
Yeah, of course. Yeah.
Yeah.
Either way.
Yeah,
we're going to need to see what markets want to do now. If you make a big move, like you've just pointed out, it's got to hold it. If it doesn't hold it, then you're back in the box again.
Yeah. So the durability of these moves that came out of the box, but I don't know. I certainly would not be short bonds anymore. So why can't we rally back to a breakdown? The question is, what's that going to do to, say, rates ease now? And the 10-year, I saw someone say, to really know that this cycle has ended in the 10-year, you needed to take out this 272 level. But pretty big tail on the weekly.
I think there's a bit of a, and as you showed this earlier, Dale, there's a bit of this prior top there from and that's
right here
to hold. Yeah, that seems to hold it just right now. It's just around 320, 319 or something like that, if I'm not mistaken.
Yeah, it's right here, this high.
Yeah, that seems to hold it just right now, and it's a bit of a coin toss, whether to see if it either breaks or and there's also the differentials on the euro and the German rates, and the spreads on Italian and German rates, who are playing around with the euro dollar a bit. I think we might be installing a little bit of a range there until we get some more clarity.
Okay. All right. And any comments on silver's given it up today, but wasn't such a bad week the way it recovered and put in a higher low. Gold, what did gold do? Gold put in a higher low, but still not as good of a week it had. The way it started off Monday, it still couldn't close higher in the week. So it's hard to have conviction here.
Yeah,
that's all I could say.
It all looks very rangy, because if you look at silver, we held that 2090 line down to the. I have a line at 2090, I have a level, probably a FIB or so, and it held really there. And then the top side 22.15 is a bit of a crossroad, and stopped right there again this morning. So I think we're in a 21-22 range. Gold about the same. Held in the mid 50s. Now we're back in the mid 40s. It looks very rangy, all of that.
Yeah, silver looks a little better, but if you're long silver, at least you know where you're wrong now. Wouldn't want to be you're long against this week's lows in both gold and silver if you're bullish, and if you're bearish, you're looking for those lows to be taken out. Euro pound all over the map. This week, I thought this was an interesting move, because I thought 86 was going to be a breakout, and instead it turned out to be a false breakout. So maybe if we get this move in euro to new lows, it's going to set up a better entry in euro pound. Any ideas? I know you're longer term bullish here, Ryan.
Yeah, well, we all jumped on the break of 86, or a few of us jumped on the break of 86. Unfortunately, we knocked it up in the highs there when it broke 87s. I took a bit off my core long as well. But you're right, it's back in the box again. Pretty much the same as euro sterling. Went all the way around the houses, went for a wander, and we're back.
Yeah.
So yeah, you know, maybe low 84s, 84, 80. That's one area to look at. Got a bit of a support, well, a bit of a support and resistance zone there. You know, historical one. Yeah. If we get below there, then you got to look down towards, you know, 84.20, 84 handle.
Yeah. Okay, so you know the weekly. That's a hell of a wick, and look what it did come off of. I didn't even notice that till just
Yeah,
now.
I didn't even see that.
Look at that. So, you know, to be a good trader, it's hard to have a job too, unless because you really have to spend time. You know, I don't delve into the charts as much as I, you know, should, because I'm busy doing other things. But you know, I should have noticed this. And instead of just going through a talk with you guys and discovering it after the fact. You know what I mean? So, oh wow, see,
it was a level up there anyway.
Yeah.
You know, off the prior highs, it was a break point below, and it became resistant. So fortunately, it was a level already.
Yeah.
So we'll let you off, Dale.
Yeah. Okay. Thanks, buddy. So I don't know what else really to talk about. I think the feature is, you know, I think there's a short squeeze brewing in bonds. And, you know, do you think if we had a bond rally, I know a lot of people were, you know, bought bonds because, you know, it looked like Crashville setting up, you know.
Yeah.
But could they, you know, if they come off, could this take the pressure off a lot of different instruments, especially risk? It should be, you can't have it both ways. If higher rates, it's been, you know, headwind for tech and everything else. You would think lower rates or a correction in rates would take that pressure off, maybe be a tailwind for a while.
I think it's going to be a question of which maturities are going to move. You know, you're going to need to, with the Fed expecting rates to go to, you know, 4% and then come back to 2.5% in 2024. You've got to, you know, you've obviously got to look at the 2 years, and you know, we're going to, rather than the 10 years, it might be the 2 years that start dictating the price moves, because the market's going to be trading the data around that. Can the Fed get to 4%? Will they need to go higher than 4%? How fast will they come back to their supposed neutral rate at 2.5%? So yeah, I think it's the shorter end that's going to be the driving factor going forward. But as you rightly say, you know, that impacts all sorts of different things.
Okay, and copper has been the worst performing metal, as silver and gold have held and put in higher lows. Dr. Copper about to make new lows here.
Do you think that's unexpected with stocks as weak as they are, or would you say that it's actually holding up pretty well considering? And good morning.
Yeah, it could.
And
yeah, good morning, Blake. I remember this day, and I, like you, said I wouldn't fade copper after a candle like this. Remember talking about it?
Yeah.
And it just, you know, gave it all
faded.
back. Huh? Yeah.
And it faded. Yeah. I mean, well, I mean, so did the equity markets. I mean, look at the, you know, I mean, the S&P broke down. I think it drug everything down.
Vicious. Yeah. This was one of the more vicious declines here.
Right. So I mean, it's, I think ultimately, I mean, if you're looking at the markets as a broad, you know, from a broad point of view, I mean, you know, what's going to lead the market, you know, what's going to have more impact on the market, you know, equity market flows or copper flows.
Yeah. So if that's the case, and silver usually gets hammered and risk off, like copper did, you have to respect the action in silver.
Yeah, and you know what? I'm stepping in a little bit late. I might have missed some of what you guys were saying because my dogs decided they wanted to get out.
Go out.
Right at, you know, as I'm starting, or as we were starting our show. So yeah, I missed your comments on silver as a whole.
I'm just saying that what I'm saying now, like with your commentary on, you know, of course copper went down. You could say, well, why isn't silver at new lows? Silver put in a higher low. So you have to respect how well silver held up with everything getting creamed.
Yeah, it's good. Just because Stelios plays silver on the long side, that's why it's holding up.
It's an inflation hedge.
It's
Sometimes
I knew I was going to say something.
Sometimes it is. Good morning, guys.
Hey, Stel.
One thing I
don't
wanted
you
to
think,
say,
Stel, that wouldn't you have thought with what the S&Ps did and what yields did, that we would have been back down here instead of near the upper end of this range over the last month or so?
I always said I feared another meltdown, which could have come from the Fed. The Fed did 75, bond yields rallied, and the meltdown didn't come maybe yet. I don't want to say that word, but it's definitely trading better than I thought. I'm still waiting for it, but yeah. It's still consolidating sideways, so we're kind of in no man's land at the moment.
Yeah.
Regarding yields, you talked about bonds earlier.
Wait, before you go into yields, you mind if I take over the charts while you do this?
No, not at all.
Please
I never mind. You know what, bro? You don't even have to ask me anymore.
All right. Well,
you just grab them, buddy.
Stelios, say what you're going to say about yields, because I want to just pull up the 10-year and the 30-year on yield. So go ahead. I've got.
Well, a friend of mine whose opinion I really value is like, do you think we've hit the top in yields? And my response was, okay, why is there a top in yields at the moment? We have pretty much every central bank, or apart from VOJ yet, and the Bank of England are also a little bit behind. But the Fed is hiking, and there's no reason for us to change the bias. I actually said I think this drawdown towards a 320 high, which was the previous high, I think is a good level to get short bonds again. And he's like, really, you don't think that it's turned? I said, well, it's in man's nature to try and call a turn, because that means that person has actually beaten the market. The market thinks it's going higher, but actually I think it's going lower. And hey, I was right. So it's in human nature to try and call a top or a bottom. I think the wise thing is to go with the trend and actually find entry points that go with the trend. That's what I think.
Okay, so I just want to pull up, and I hear exactly what you're saying, and it is a bit of a
stupid opinion.
No. I was gonna say it is just kind of, if you watch the move in yields, like here's the that's the 10-year, here's the 30-year. You see the reversal and you do scratch your head. I mean, it is a bit of a head scratcher. I mean, Kman, Ryan, do you guys have any opinions on why yields are actually coming off with what the Fed's done this week?
Can I say one thing before they come in? I think Dale nailed it. He said that everything was so bearish. The sentiment, positioning, it has to relief.
Okay.
Anyway, carry on.
Okay, and I missed those comments, but
I think in one sentence.
Oh God, Steve, you never say one sentence.
You can do
a 14 sentence long, 10-minute long explanation.
Notice how you said 14 sentences instead of letting me say one. Yields are climbing a wall of worry, and I think they will continue to climb it.
Okay, thanks, Steve. And I'm just harassing you, but
I know.
But what I want to say is, the 30-year yields have really backed off some highs that we haven't seen since 2019. The 10-year yield also got a little false break, and if you look at the bond market too, and let me just clean this up for a second. Here's your 10-year. This is the 10-year traded bond market here, and you can see. Spike low, we're seeing a reversal. I don't know why. And I mean, I know you guys have all your explanations, and I know I'm always in the camp that I can't explain everything. There's a lot of things that I don't know the answer to. And this is one of those that I am a bit of a scratching my head. Ryan, did you have any opinions here?
Yeah, I think Charles has pretty much nailed it. Peak hawkishness.
So you guys just think it's everybody's one-sided?
It's part of that, and it's also the market now saying, right, well, the Fed have got their plan. They had their plan 2 months ago. That plan's changed. Now we're going to reprice that next plan. But now it comes down to the economy. What's the economy going to do? Fed's going to hike 75 pip clips. We've seen housing 2 months on the trot now. Housing market numbers deteriorating. The consumer seems to be okay, but there's maybe some wobbles coming in. Price metrics in the early manufacturing data, Empire and Philly are dropping, but employment still looks up. you know, now we're getting into that part of the show where the data has got to match what the Fed's saying. And what, again, it's back like we spoke about a couple of months ago when we had the Fed. What are they going to do? How much more do they have to do now to send yields higher? How much more hawkish do they have to be to send yields higher? The market is pricing. You know, if it can't break, if yields, 10-year yields can't break the 350 highs, the market's happy with where they're at with rates.
Possible answer to your rhetorical question, Ryan, would be the following. We don't have any historical example where inflation has started running away and we managed to tame inflation by having negative real rates. Meaning that in every instance from the past that we've had inflation running away, which is obviously the case here. I mean, even central bankers admit to that. We've had to raise rates higher than inflation to tame inflation. So if that historical precedent holds true once more, that means that potentially yields will have to move much, much higher than where they are at the moment.
All right. Well, it's going to be okay. I don't want to completely. Go ahead. No, I don't want to completely shift gears, but today we have here in like, I don't know, 25 minutes. 25 minutes. Yeah, we have Powell speaking on the dollar.
Oh wow.
Yeah, what do you think he's going to say about the dollar here? I mean,
that's not supposed to be their purvey. You know, that's supposed to be the Secretary of the Treasury.
I know, but his speech is called. Let me figure out what his speech is called. It is the welcoming remarks at the inaugural conference on the international role of the U.S. dollar.
Listen, Blake, I have no idea what he's going to talk about, but, you know, I can tell you two things for certain. A, unfortunately, the U.S. is not an exporting economy anymore, right? It imports a lot more than it exports. And it has a very big inflation problem. For both of these reasons, a higher dollar is a good thing at the moment. So I can think of no logical answer of why they wouldn't embrace a strong dollar.
Right. Yeah. I mean, it's one thing that's bluntly holding back a much higher rate of inflation here in the U.S. is the stronger dollar that we have. So there's zero reason. I agree that zero reason for him to talk it down.
Exactly.
So yeah, but it's going to be interesting to and maybe traders are thinking that why the dollar is up right now. But I got to show you this as far as the dollar index goes. Technically, we are, you know, the breakout point was 105, and we got a failed breakout this week. Now we're bouncing back a little bit here. But overall, you know, you got to think the dollar is still trending higher, still holding up pretty well. But the euro is aggressively bounced off of the lows. I mean, you know, after this week, you know, and I have to say that after this week, after what the Fed has done, and you all know, especially if you trade currencies, the dollar holds up. I mean, the dollar trades, you know, based on interest rate, you know, moves and expectations is, you know, and when you talk about yields, and we were just having this discussion on yields and why yields aren't going higher anymore. I mean, the dollar's telling you basically the same thing, that, you know, maybe we've worked out all of, you know, the hikes. The Fed is, you know, kind of all priced in at this point, and the dollar is too. The dollar's lack of ability to break through 103.50 or 103.30, it is very glaring. If you do trade currencies, you have to be thinking this right now. And I am playing the dollar on the short side, just FYI.
But looking for on the other hand, Blake, the most glaring thing, if you pull either of these charts, either we're talking about the euro or the DXY, is that we still have a very obvious sequence of lower highs in the case of the euro USD.
Yeah, and it's a wedge.
Yeah, but I mean, you know, the most defining characteristic of a downtrend is the lower highs, and of an uptrend, the higher lows. And that's so far, we haven't invalidated either of those two in these two charts, right? The DXY is still registering a sequence of higher lows, and the EURUSD a sequence of lower highs.
Well,
Can we break that?
Yes,
of course we can.
Creating equal lows. So now it's developing more of a wedge, which is now a more of a risk for it's now tilted the risk back over to a potential reversal. Not that it's just the percentage numbers are getting better for a possible reversal. So that's all that's happening here. Consistent lows and lower highs, still a wedge, still bearish, but instead of being more of a 70% chance of a continuation, now we have more of like a 60% and now a 40% chance of going the opposite direction, which is the percentages are now starting to move in a different direction for the euro as far as shorts go. So and that's the thing that you see it in yields, you see it, and you also see it in precious metals. You saw it in silver, as Dale was pointing out. Even gold starting to not create lower lows. What if gold finally breaks out above 1875? If it can break 1875, 1880, we might actually have a chance in gold to make a move, and then Stelios will retire.
Forever.
So hey, one of the other things I need to point out is Bitcoin. Now FX Macro just tweeted something, and I think this is interesting. I'm going to say it here. 72 of the top 100 coins have fallen 90% or more. 72 of the top 100 crypto coins have fallen 90% or more. So what does that tell you?
Nothing that we didn't already know.
No. What does that tell you?
And I'm not joking about it, because
no, you have 28 of the top 100 that have more to fall. How about that?
I'm with you.
And it's probably the biggest ones, right? Because Bitcoin is only fallen, 65% or something.
Only.
Right. I still think. Hey, look, I met with I met yesterday with Gareth Soloway. He has a downside target of 12,000. He has some pretty good reasoning why. But and I think you guys should watch that. You'll watch that video later today on Trader Summit. Remember, you guys don't go over here to Trader Summit. I do interviews, try to do a couple a week right here. So check them out. And plus people post here this is a great place to start your day, because you can actually get new articles every day, every morning here. Anyway, but the one thing I must say about Bitcoin, even though we're at 20,000, does it look like a screaming buy right now? I mean,
nope.
I mean, look, are buyers just like, did sellers capitulate and everybody's screaming, running in to buy Bitcoin right now? No.
Nope.
It's just sitting here. When price action is an interesting animal. Like whenever I see things that go like this, and I'm just going to move this out a little bit, and well, actually, you know what? I'm just going to draw it here. If I see price action looks like this, and we just, we get to a support, that's just aching to break down, right? So when you're trading and you get price action, it looks like this, you have to wait for a capitulation type of move where buyers step in and say, that is the time I want to be long. Right now, what we have and where we're at with Bitcoin is it just is sold off, and now we're just finding support at the lows. We'd have to sit at 20,000 for a long time in order for me to even think about buying. I mean, we'd probably have to be down there for months before, if Bitcoin just stops at 20,000 and we bounce between 20,000 and 20, let's say 25,000 for the next 3 or 4 months, I might actually consider buying Bitcoin. But until it actually at this stage in the game, until we clear every long out, including what's his name from MicroStrategy? What's his name?
Michael Saylor.
Yeah, Michael Saylor. I always want to say Robert Saylor.
By the Sailor Man.
Yeah. Yeah. But until we clear that out, and until, like you look at this, some of these trend lines down here, they come in at 7,000, 8,000. breakout points around 10,000.
That's what
Those are
Gunledge
all,
thinks.
those are not off base in my view. And I think we could get a capitulation type of move down to those levels. And then I'll be buying somewhere down there, and it's going to be with money where I can just put it away and not think about it anymore. Cause that's the kind of money that I'm going to be putting towards Bitcoin down there.
And likely after a point of time, you won't have to think about them because they won't exist.
Well, and if that's the case, then that's going to be the case, but that's the way I'm approaching Bitcoin, and I still think it's trading extremely heavy. So when you see a stat like that, let me just say that again: 75 or 72 of the top 100 coins have fallen 90% or more. All that tells me is there's another 28 that have further to go.
Yeah, and don't forget, right? So, 19,700 and something is the number. We got very, very close to 20,000 of these things, right? Mm-hmm. There is 99% of them will completely vanish.
Just so if you guys weren't trading in the 90s, in like I started trading in 95 through the .com bubble. And this is and we've said it for years here on F.A.C.E that Bitcoin cryptocurrencies, this is .com all over again. So for those of you that didn't trade through the mid 90s and late 90s, this is exactly what it looked like with internet stocks.
Have a guest today, bro.
Huh?
I know you're not used to it, but we do have a guest today.
Oh, we have a guest on Friday. Shoot. Yeah, I definitely was not used to it.
Who do we have, Dale?
We have Jim Carroll. I'm trying to promote him. It's not.
What's that? Jim Carrey?
Jim Carroll.
Oh, Carroll. Okay. Sorry, I misheard.
I see him. I'm gonna.
All right. Thank you, Steve.
Okay. Yeah, next week get me Jim Carrey. Okay.
All right.
All right. Now bring in Jim Carrey. No, sorry, I didn't. And Dale, I want to thank you for reminding me because it is a Friday. I wasn't completely aware. But let me just finish up my thoughts here.
Go ahead.
On the 90s, just for those of you that lived through it, this is what it was like. But I, fortunately, I stayed away from all the altcoins. But it was 90%, 95% of all of those internet companies, stocks, those .coms, they went away. Same thing's going to happen with these altcoins. There's probably going to be a few that stick around. And
you don't think Pets.com is going to recover?
What's that?
Pets.com?
No, you know what? It's funny. My mother-in-law, she was on the board of mother-in-law. She was on the board of Pets.com. Her college buddy started. They were started here in Phoenix, Arizona. That's why I'm telling you that.
Oh, interesting.
Yeah, and they went bust.
Anyway, yeah, some nice wallpapers. I'll stock.
Yeah, exactly. All right. So anyway, hey, I want to say, guys, if you haven't checked out the Trader Funding Program, they are the sponsor of our show. And make sure you go down to the bottom, watch the 2-minute video right here of me and Boba Fett. Boba Fett does some speaking. I'm just kidding. He doesn't. But we have just enabled the $1 million account as of last week. We had 2 new live trading accounts get fired up this week. Right, Stelly?
Nice.
Is this 2? Is that the number I have? Is that correct?
He left.
Yeah, I think it was 2. I think we had 2 new live accounts. Like people went through the assessment and qualified for live accounts this week. 2 or 3, something like that. Anyway, so it's cool, man. You guys want to check it out? Trader Funding Program. Dale, it's all yours. Thanks, everybody.
Thank you.
Have a great weekend. TGIF.
Have a great weekend, team. Thanks for laying it all on the court.
Cheers, guys.
For John Q. Public again this week, and our trading family at ForexAnalytix. And Jim Carroll, welcome back to F.A.C.E, Jim. How are you? Got your mic going, buddy? Hi, Jim.
He's certainly unmuted.
Hi, Jim. It sounded like it almost came on.
Jim, make
Jim,
sure
you have me.
Yes, now we
got
can.
you now. Yeah, Jim, got you, buddy. Welcome back.
Dale?
Yeah, I got you, Jim. Welcome back. Can you hear us? Hello, Jim. Huh. We see and hear you, Jim. Or we did. And lots of people waiting to hear from you. Jim?
Okay, I'm assuming that he hasn't selected the right
Audio source.
Yeah.
Yeah.
Speaker, so that's why he can't hear us. His microphone seemed to be working. I wrote it to him if he sees the
Yeah, I
chat.
see it. We'll give it a couple minutes. Okay, everybody together now.
Well, you've had Jim on here before, haven't you?
Yeah.
Yeah. Okay. So yeah, I remember Jim.
Hey,
being
Dale, you
on.
got me now?
Oh,
Got
there he
you,
is.
Jim. Yes. Hi. Where
Sorry.
were you? You
I
out
don't
in
know.
VIX jungle?
Technical difficulties.
Okay, buddy. Well,
Always
Jim,
something.
you should have grabbed like your kids and brought them in. They usually can fit. I'm like, I got a technical issue. I go grab my teenagers.
Yeah, my kids are a little older than yours, Blake. They're
go grab your grandkids then. Just kidding.
still waiting
Jim.
on those.
Yeah.
Good.
Oh, there you
Good
go.
for you. Good for you.
Yeah,
Hey,
and you said
thanks for
patience
joining us,
is-
Jim.
Patience pays, Jim, and
Yeah.
so you're going to have to be patient with me. I don't know if you're going to share your screen or not. Are you?
I have some things to share if that
Okay.
works for you.
Okay, that's fine. That's on the bottom, the
Yep.
green button. So I know you've probably heard this ad nauseum for months. Why isn't the VIX at 50, 60 with this severe bear market decline that we've had in equities?
Okay, let me try to address that. Are you seeing my screen
Not
right
yet.
now?
No, you
Okay,
click
so
the
hang on.
share screen,
Yeah,
and then you then it says share,
right.
and then it should come up.
Yeah, hang on one second. Okay. Let's go here. Let's go share.
Okay, it's coming
And
up.
then let's go
Okay.
here. Yeah.
All right. Yeah. What the hell is wrong with the VIX? Like it. All right. That's what everyone's saying, especially people who bought VIX calls.
Yeah, it's broken.
Yeah. Is it broken?
Well, not really, but let's walk through a few things.
Okay.
So, you know, what's driving everybody crazy is that, you know, for the last month and a half, we've been printing new lows. We had a little bounce, you know, at the end of May.
Yes.
But, you know, VIX doesn't seem to want to budge. And here what I'm showing is VIX in the bottom,
Yeah.
right? And we haven't been able to break out above that 35 level, which is what people were expecting as some sign of the capitulation. And, you know, the middle panel is showing the ratios of the different SIBO tenors of volatility, right? Because SIBO's got
Right.
a 9-day, a 30-day, a 3-month, and a 6-month, and a 1-year even now. And you can see particularly the blue and the green line, which are the VIX to the VIX 3-month and 3-month to 6-month, just refuse to get above that one line, which would suggest that, you know, things are really in backwardation using that term structure. And
Okay.
we're just not there. You know, so why are we not there? Well, one of the reasons we're not there is because, you know, a line that goes from lower left to upper right, a straight line that goes from lower left to upper right is what we're all seeking in our investment returns, and that has zero volatility. You know, if you look at the decline, particularly from April to mid-May, it was pretty much a straight line going the wrong direction. But, you know, again, that's relatively low volatility. You know, people were referring to this decline in the S&P as a grind lower. And, you know, that's been a fair characterization.
It was orderly.
Orderly, exactly.
Yeah.
And so orderly declines just don't tend to provoke, you know, big spikes in volatility. The other thing that's happened, though, is if you take a look again using SIBO's and I like to use these because they're constant maturity, right? If you look at the VIX futures, the maturity of each of the contracts is changing every day, right? And so, I like to use these to get a gauge. And if I look at, the trailing 12-month average for these guys, there's a nice contango shape to that term structure where, at yesterday's close, not only was it elevated and relatively flat, but we also had 9-day, as an outlier up there, because everybody's still nervous about, today's options expiration and, what might happen over a long weekend and all that stuff. But, we have to remember that a 34 VIX, the shorthand is to divide that by 16, and that implies daily moves of 2+%, which on average is kind of what we've been getting, right?
Exactly.
So why should VIX be any higher? The answer is there's no particularly good reason for it to be higher than it is right now. And, everybody wants to see that capitulation spike. Well, guess what? I guess we haven't capitulated yet. Now,
we're not going to have one, and that's how everyone misses the bottom of the market.
Bingo.
They're waiting for that. Is that what you think, Ben?
Well, I wouldn't. Let's put it this way, Dale. I have no clue, but
yeah, me either.
I wouldn't be surprised.
I guess,
Yeah, we all guessed. So again,
it's fun to guess.
Yeah, well, you look.
We're all put money on it.
Exactly. Once you put money on it, you're making a prediction.
Yeah.
You may not view yourself as somebody who makes predictions, but implicitly you're making a prediction. Right. And by the way, I try to keep any of my predictions to myself to avoid looking dumber than I am. But we all have to recognize that that's the business that we're in.
Right.
Some people are more humble than others. Looking at the VIX futures term structure, again, what you see is that we're elevated. I'm sorry, the green is a little bit faint.
We see it.
But we're elevated. We're incredibly flat over the term structure. And so again, we're at high levels of implied volatility right now. No particular reason at the moment that we need to be any higher.
Okay.
Here's another way to look at what's been happening with the term structure. And there are a lot of squiggly lines on this chart, but what it's showing is, again, going back to the SIBO volatility measures, the standard everything's okay array would be for 6-month volatility be greater than 3-month, greater than 30-day, greater than 9-day. And, what we're seeing is compression in the range of those indicators. And that means the term structure is flattening, which we saw on the prior slide. But at the same time, it's not moving higher. It's just squeezing into a narrower space at an elevated level.
What could be the catalyst for a breakout over 35?
That's a really good question. But it's going to take, a sharp move, and it's going to take something that is a bit of a surprise. People would have said that 75 basis points from the Fed on Wednesday would have been a surprise, except that, they leaked it to the Wall Street Journal.
Yeah.
Had they gone a full 100 basis points, that would have been a different animal and could have caused a breakout in volatility. But, we need something that truly is a surprise to the markets. And, what would that be?
You mean like Putin using a tactical nuke in Ukraine?
Putin using a tactical nuke in Ukraine might do it. Some breakout in some geopolitical event. Food shortages causing riots in wherever.
Everywhere.
There are a bunch of things that we can imagine.
Because when you look at this formation, it actually, it's bullish. It hasn't broken out yet, but it's an ascending triangle. You have the bottom uptrending and a flat top. And that's you go to Edwards and McGee, that's a classic reversal formation. an ascending triangle that portends, doesn't guarantee it, and you never know when,
Right.
but actually gives the odds of a breakout to the upside eventually.
Mm.
That it looks like that could happen.
It certainly does look like that. And, again, when the term structure, whether you're looking at the VIX futures or you're looking at the SIBO indices, when the term structure flattens the way it is, particularly at a fairly high level, that flat suggests indecisive, right? We're pricing today's volatility the same as we're pricing volatility a year from now. And that in normal markets doesn't make sense. You would pay more for insurance a year from now than you would 9 days from now. And so we need something to flip that term structure back to its more normal state. And look, that's just not going to happen easily.
Do yields come into play at all?
I'll get there.
Oh, okay.
Certainly the bond market does, and I'm going to come to two things that I keep an eye on as some indication of what's happening in the bond market, because I do think intermarket relationships go back to Murphy, right?
Yeah.
Whether it's looking at currencies the way you guys do on a daily basis, commodities, it's important to look across assets and figure out what they're suggesting about equities or whatever it is you choose to trade.
Because bonds did not work as a safe haven either. In fact, they led the decline in equities.
Bonds have been horrible.
Yeah.
And that has caused, a lot of, I think, just talking to my own clients, talking to other advisors, the fact that bonds have failed as a diversifier has created a lot of problems, among investors for whom that 70-30, 60-40, has been a bedrock of stability.
Yeah. Yeah. A lot of 401ks are.
So here are a couple of examples of, things that aren't working that are volatility related.
Okay.
The SIBO has this P-put index that they publish, where you own the S&P 500 and you own a 5% out of the money put, right? So market down, put should go up. But as you see here, again, that steady grind lower, that premium that you're paying for the put, you're not collecting anything to speak of on that put. Maybe it's offsetting, the cost of the put, but it certainly isn't giving you any bang for your buck. Since the P-put index has basically just tracked the S&P 500 year to date. So put protection has been, a loser. Again, just using this particular index as a gauge. So what about, VIX calls? Well, SIBO's got an index for that too, the SIBO VIX tail hedge. And so that is buying out of the money calls on the VIX as a way to hedge your tail. And, it seems to me that down 21% in the S&P, might be viewed as a tail event by the average investor. But once again, that the premium paid for those calls because of where we are with implied volatility, hedging has been expensive and it just hasn't paid off because we haven't had the outlier event, the convexity event, to cause those S&P puts or VIX calls to really pay off. And it's been very frustrating for people, but it's the nature of this grind down, a little bit of an uptick, grind down some more, market that we've been in year to date.
Yeah, I guess the guys doing strangles just, writing calls on every VIX rally and writing puts on every, VIX decline. It probably has been working hugely instead of directional. So what are people doing? They shorting volatility?
Well, shorting volatility has not worked that well either.
Again,
because we've had these whipsaws, you know, you get your face ripped off when the S&P turns around and rallies 5 or 10%, and then you try to short it again. The other thing is, you know, when do people prefer to put on short vol trades? They prefer to put short vol trades on after the VIX has spiked, you know, to a measured level. And again, you know, we really just haven't seen that reliably year to date. You know, VIX has just gotten into the 30s and stayed in the 30s. We've had a couple of circumstances where shorting that, you know, would have been okay, but you also have to be much more nimble. I was having a conversation with an advisor that I know the other day, and you know, we were talking about how we're approaching the market, and he tends to be fairly active, as do I, and we agreed that, you know, one of the challenges in a market like this is that you have to shrink your time frame. You know, if you were putting on trades for months and years,
now it's days.
You know, you're down to weeks and days.
Okay, yeah.
This is a day trader, swing trader market, in my opinion. And oh, by the way, you know, who does that? Not very many people. You know, certainly there are a very small number of advisors who are comfortable being that tactical. Your average investor has no idea what that even means to be a swing trader. So, you know, I think this is a market where professional day traders and swing traders have been able to make money, and it's been a complete nightmare for most of the rest of people.
Okay, and
you know, you said during the first half hour, one of the things you said was it's hard to have conviction.
Yeah,
and I couldn't agree with that more. I think you need to throw conviction out the window for the moment, and take what the market is offering on relatively short time frames. And if you're not comfortable with that, then I think you need to, you know,
be out of the market. Boy, that's an option, isn't it?
It is an option. And, you know, I run some short-term momentum models that are out of the market. Now, you know, people say, well, how can you put money in cash, you know, with inflation at 8%? Well, if I'm losing 8% a year and the S&P is down 20%,
yeah,
you know,
it's a lesser of two evils.
Lesser of two evils. And I think we are also in a lesser of two evils market right now.
Okay, Jim.
Let me keep moving.
Go ahead.
So this is a chart that shows the performance on the top. It shows the performance of the S&P, right?
Yeah.
And it shows the performance of an ETF that is designed to hedge. You know, so again, what we're seeing is the hedges just aren't really paying off to any extent. And the bottom panel shows 4 ETFs, 2 of which are, you know, long short or short biased,
like
ETFs. Well, yeah, except that these are managed,
okay.
Short biased.
Okay.
One is HDGE, which is Ranger, and then there's a Dorsey Wright short ETF, long short ETF. And, you know, no surprise, those have done really well in the last couple of months, where if you're really just looking at hedges, tail, right, is designed to be a tail hedge. CYA is, again, designed to be a tail hedge. And year to date, you just haven't gotten any real payoff from those, right? If you had taken your S&P portfolio and said, I'm going to give 80% to the S&P and 20% to one of these things, or, you know, some mixture like that, it hasn't added any value. You know, you're down basically the same amount as you would be if you were just in
you hadn't have done it.
Yeah, so the tail hedges just haven't worked.
Okay.
Bonds. Okay.
That's where it's been. Yeah.
Yeah. So, you know, what we've seen is you know, a big surge in bond volatility measured by the MOVE index, which, you know, a lot of people say, well, it's not that great. Well, it's kind of what we have. You know, it's a reasonably well constructed measure of bond market volatility. And you know, what's plain as day is that there's been more volatility in the bond market and in bond yields than there has been, you know, in the equity market. So, you know, that's been a big source of market vol.
Okay. And so, you know, I've heard people talk, there's a huge gap between, and you're showing it.
And if you listen to the guy who cooked this up when he was at Merrill Lynch a bunch of years ago, is a guy named Harley Bassman, who is the convexity maven on Twitter, has a blog, and is also involved with a company called Simplify ETFs. And Harley sort of downplays, you know, this spread between the MOVE index and the VIX index. You know, it's not like the VIX index has to catch up with the MOVE index. It could, but from his perspective,
go the other way.
Yeah, from his perspective, you know, he doesn't put too much credence into big gaps between the two.
Like a mean regression.
Right. You know, he doesn't want to take people there because he doesn't think it's anchored in, you know, how they really work.
Do people short bond volatility, the MOVE index? Is there a way for them?
The MOVE index. The MOVE index, like the VIX, is not investable. Okay. You know, so there certainly are ways that people can take a view on bond volatility. It's not my particular area of expertise.
Okay.
And I think that, you know, you can certainly short rates, or
you could just buy bonds.
Yeah, there are any number of trades you could put on to express a view that bond volatility has gotten out of hand and needs to come down. But the index itself is not investable.
Okay.
So Dale, let me finish with a couple of things that I'm keeping an eye on. One of which is I keep track of 52-week highs and lows, and then I net them out, so it's new highs minus new lows, and then I sort of smooth that out by taking a 5-day cum. And what you see on this is that that new high, new low broke through the zero line back, late last year.
Yeah.
And has struggled to get back above it anytime this year. Minus 4,000 is sort of the depths of despair. And, we just broke down below that again. So, one of the things I'm keeping an eye on is some relief from this measure of market breadth, to give a clue as to, how equities might behave. We need this to reverse. Bulls need this to reverse. Bears are happy as clams, with this down where it is, and happy to have it go lower.
Yeah, they'd like to see it revisit the COVID low.
Yeah, sure, why not?
Take it down to minus 11,000.
And it's possible that we could get there. And one of the things that's interesting about here, I don't have it on this chart. Let me see if I can find it. But if you go back to the COVID lows, this actually turned around and was heading back up when the market made its March 23rd low. So, it had...
It led.
It led. And
nice.
So, we'll see what happens going forward. I have no idea, but it's one of the things that I watch on a daily basis. One other thing that I keep an eye on, and it's not terribly bullish right now, is a measure that Tom McClellan came up with, the McClellan oscillator.
Right.
If you're familiar with some of the work that he's done. And there's data that's available that shows for the high yield market advances and declines in high yield bonds. And what he figured out a while ago was that if you could keep an eye on that cumulative advanced decline line for high yield bonds, it might give you some clues. And, going back, you could see in 2015, 2018, where again, weakness in the high yield market as reflected by advanced declines gave you a heads up that there might be some weakness in the equity markets. That the pandemic sort of came as a surprise to everybody.
Right.
But now, we're in this phase where high yield AD rolled over before the equity market really did. And you can see a couple of little bounces in here in that red line, but they're little bounces and followed by resumption of the downtrend. So, this is another one. This is one of those, intermarket indicators where the high yield bond market may be giving us, some sense of what to expect or what to be concerned about with the equity markets.
Do you watch the spread between treasuries and high yield as well?
I sure do. And, one of the things that we haven't yet seen is that spread blowout. Certainly spreads have widened and yields have risen by virtue of the underlying treasuries going up in yield and the spreads widening. But we haven't seen, a blowout in terms of spreads at this point. A lot of people are watching for that. If we do get that blowout, it's not, again, it's sort of like this chart. It would probably not be good news for the equity market.
Yeah.
And it's definitely something that people should be paying attention to.
Really appreciate you sharing your models and some of the things that you pay attention to, Jim. Great presentation on what's happening with volatility. You're definitely the guy to talk to about all of this going on and all the questions people have about underperforming. And I did notice a tweet that you said, patience pays. And I think that is an implication that you think eventually we will break out over 35.
I come from the school that says nobody knows.
Yes.
But I also come from the school that says, if you pay attention carefully to whatever market you're trying to trade, my experience is that there are some breadcrumbs. I think the reality is that most people, even a lot of professional investors, aren't really paying careful attention. They got other things. They got wife, kids.
And they're not interested in breadcrumbs anyway after the most prolific bull market in history over the last 20 years.
Buy the dip.
Crumbs.
Buy the dip. Well, and what I'm really saying is that there are clues for people who really kind of want to put the work in and pay attention. That's my belief, and it has served me reasonably well. So I encourage people to, broaden their scope of vision and start paying attention to things that might help them manage their portfolios and preserve and grow their capital.
Jim Carroll saying, pay attention to the clues, and thanks for cluing us in, Jim. Thank you, my trading warrior brother. Really for a great interview. I'm going to watch it again because there were some points I need to hear again. Appreciate you being here and look forward to the next time we get together.
Always my pleasure, Dale.
Yeah, so you could find Jim on Twitter at VIXologist and also at Taroso. So follow Jim, and he's fairly active on Twitter, and you'll know what he's thinking. And
I'm active on Twitter, and people can send me direct messages, and
cool.
As long as it's friendly and polite, I will respond.
There you go. Civility on Twitter. Jim's asking for a breakout in the VIX. So they're both as likely. So anyway, Jim, thanks so much, buddy.
You're welcome. Dale.
Have a great trading summer, and look forward to talking to you again in the fall.
Excellent. Thank you.
All right, everyone. That's Jim Carroll. Hope everyone had a good week. We've done our best to provide, risk management ideas, some actionable ideas, and hope you guys have had a decent week. Feels like a month this week to me. So know what you're going to do next week and figure that out on your kitchen table over the weekend. You could join the team in 10 minutes for the morning edge. And remember, most of all, don't just count your pips, count your blessings. Adios. Thanks again, Jim Carroll. You're welcome, Mary.
Thanks, Dale.
You're welcome, Jim. You're welcome, Sinatra. See you guys.